futures, swaps, futures and forwards, swaps, value investing. Value investing is another topic. Okay, is that right? You'll take futures and forwards. Okay, fine. So that's another topic gone. The rest of you just play around with these topics. And if I think of some other topic, I'll come to you later. I'll tell you again. Okay. So what we're going to do now is we are going to just quickly give you your readings. You'll see in your notes there's a reference to readings of chapter 11. Very few, 4 or 5 pages. Okay, I've changed the page numbers to fit the 10th edition. Okay, so please make sure you do the readings. Okay, from time to time when I insert readings into your notes, you're supposed to do the reading as well. If I give you a link, like I gave you a link to this matter, that particular on the option Greeks, you're supposed to do those links, readings, not just read whatever's in the class notes. Okay, shortcuts will not be useful. Okay, so let's quickly go to. This is the problem. This is why I wanted to have that portable mic system. This is just 7 days. We don't want 7 days. Let's take this. All right. So let's go back to your page here. Okay. Right. Today is 10:10. So I've given you a heads up on the readings. You make sure you do the readings, which are there in your notes. Okay, so we're going to quickly recap the decision problems in option trading, okay, just to summarize everything. All right, so these are all familiar to you. We will just quickly run through them, but just be familiar. Always in your mind, run through all the decision problems so that you have a clear identification that these are the decision problems, okay, because normally you don't have a decision problem focus in the standard textbooks or in the normal approach to studying this subject. So we have a decision problem oriented approach, so make sure you always understand asset classes, markets and instruments. That's already solved by the investor mandate. All this stuff in underlying market. Exercise style, as Saroni pointed out, that's also a decision, but normally gets solved by the investor mandate because I have forced you to trade US equity options, so there is usually a convention. Okay, so it's like if I tell you to drive and you happen to be in the US, then which side of the road to drive on, you can't make that decision because it's already decided by convention. So if you're driving in India, which side of the road, again decided by convention, you can't decide it. So I forced you to trade US equity options, which means they're American style. Okay, the individual equity options and whatever you're trading options on individual equities and on ETFs, all of which are American style. Okay, index options are, there's one very popular index option contract which is European style. So there also it's all decided. Okay, now here are the major decisions which we have to make, whether to buy or sell options. And then again, please understand, don't make this thing whether to buy or sell options, then the answer will be don't just, no, it's not call or put. What is the question? Whether to buy or sell when you're trading in options, because your instrument is options. Okay, you've got a particular set of underlying markets, which is the underlying markets given to you. Okay, let's go back to, we can open it here in your, let's open your calc file. So in your calc file you'll see the list of markets, so you have to go through all the markets individually, and so those of you who will be doing futures and forwards, like you're doing futures and forwards, right? So you have to understand all this stuff like pricing of forward contracts, and as an example FX forward contracts, you have to read up on that. I'll give you the text, you have to read it. So the objective is to develop like in-depth product knowledge. You should know the product inside out. All right, so option strategy, there's a list of options here. So you have a list of option markets, okay, which you know, some of which you can see here. So you have options on all this stuff like Microsoft, Oracle, Procter & Gamble, FX, Ford Motor, and so on and so forth. And these are, right, this is already pasted into your notes, I think. So anyway, I'll paste it into your notes. This is okay. Yeah, this is actually, I'm reading from your notes. All right. Okay, so how do we decide this? With respect to options on Microsoft, so I'm splitting the decision problem now. I'm talking about two different decision problems. We've already done this, right? So when I come to Microsoft option, when I'm taking, let's say we take Microsoft as a first market to trade, we'll go through all the markets in turn, okay? That's what you'll have to do when you are running the project. Okay, so when I come to Microsoft options, so when I look at the first decision, whether to buy or sell the options, so how is that solved? With reference to what? Is my question clear? When you're trading options on Microsoft, okay, we can come to call and put, that we'll come to later. But the first question, if I choose to ask, you can decide which to ask. I just happen to ask the options question first. Should I be a buyer of options or should I be a seller of options? How do we solve that problem? What is the method that we follow? Is my question clear? I have to trade Microsoft options, okay? Yes? Taking a view on what? No, why underlying? Why underlying? When I'm talking about, one sec. When I'm talking about whether to buy, my first question is whether, I've not come to the question of calls and puts. I'm asking a general question. I'm doing a project where I have to trade options on individual equities and ETFs. So one of them, I take each of these tickers one by one and I go through the same set of decision problems. So I've picked up Microsoft first. So Microsoft options. Should I be a buyer of options or seller of options? How do I solve that?
View on the market, sir, if it will go up.
View on which market?
So the underlying set market, sir, if you think that it will.
Anybody else, any difference? He's saying view on the, yes?
Market is, it depends whether the market is bearish or bullish.
No, which market? In the case of options, we have a couple of things to look at. It's not simple. Yeah, so yeah. No, not US equity market. So, see, no, the point I'm trying to get at, I think you were saying it, maybe you're not saying it, but you mentioned it underlying as well, okay? So, whether to buy or sell options, that's decided purely by the eyeball view. What did we say eyeball is? Eyeball is just a index of option prices, right? Didn't we go through this exercise? So I'm glad that we are going through it again, because it's basic logic, because we have to fit it into our basic decision framework. Okay, this part is already in your notes. All these things are already in your notes. This is in your notes file, okay, to see where the writing is being done. So this two arrows means decided by the, don't say whether to buy or sell options means eyeball view, okay? Don't just mechanically read the notes. This is why you need to watch the video, okay? So, basic decision problem, are you following, Gulati? So, when I'm trading options on Microsoft, okay, I'm choosing to ask this question first. Then I'll ask the question of whether call or put. I'm splitting up the questions. You can always decide to ask call or put first and this one later. I'm just choosing, I've just happened to sequence it this way, okay? So, is that a legitimate question when I'm trading options on Microsoft? The first question I have is, should I be a buyer of options or should I be a seller of options? Is that a legitimate question?
Yes, sir.
Okay, so my question is, how is that solved? By reference to the eyeball view. So what do? I call up the eyeball chart. You guys have to set up the charts yourself. So this is the best we have right now in terms of long-term eyeball data. Okay, I'm not going to fiddle with this because the internet connection here may not work. So what am I going to do? I'm going to pull up this chart. We have a little bit of like 2 years or something of data, 2.5 years. So I'm going to take a view on this red line. This red line, which is the eyeball chart. This is basically giving me an index of option prices. It shows me that option prices have been going up and down in this manner. Okay, here they were going up, here they were coming down, etc. So I need to take a view on which way this red line is going to go. Is that clear?
Yes, sir.
Okay, so if I think that this red line is going to shoot up now to 40%, this 0.4 and all, this means 40%. Okay, this means you can see how much balls move. Okay, you can see this here, it went up to 60%. Okay, which means basically the vol input here, the eyeball input to equate it to the market price, the eyeball input here would have had to be 60% in order to get this output equal to the market price. Remember? So the eyeballs went up to 60%. So you see how this stuff moves. So you have to now take a call on this, right? So just like if I put you on the river as a boatman and you've never been on that river and you have to navigate the boat, what do you have to do? You have to basically take a call on how the currents are coming and all that, right? So you just have to use your instinct and take a call. Here you can't even do much fundamental analysis because you don't have access to the information. So this view taking is pretty much purely technical. You have to look at this chart and take a view on which way you think this is going. This is clear? Okay. So if my view is that this is going to shoot up to 40% or so, okay, then what will I be doing? Will I be a buyer of options or seller of options? I'll be a buyer of options, okay, because we know that when the eyeball goes up, generally prices of options, all options will rise.
Yes.
Okay. So this is how you solve the basic decision problem. So you need to structure it clearly in your head, okay, so that you have a clear-cut framework for trading options. First, you take a view on the eyeball. Okay, you can take it the other way also if you can take a view on the call put first, but we are just putting it this way. We just happen to sequence it. First, you take a view on the eyeball, and that tells you whether you want to be a buyer of options or a seller of options. Is this clear? Okay, this should be clear to everybody. So I'm just writing it this way. So please don't as a shortcut. So this is based on, how is this derived? This is derived from eyeball view. Okay, so please don't say that whether to buy or sell options means eyeball view. Okay, don't mechanically decide this. Okay, you have to understand what is being discussed. Okay, is this clear? These are major decisions we have to make. We already discussed all this stuff. Type of option to buy or sell, call or put. Okay, how do we decide this? Now I've decided, let's say my view is bullish on Microsoft, okay? Let's say my Microsoft view is bullish on the eyeball, on the eyeball of Microsoft options, my view is bullish. So it's going to shoot up to 40-50% or so, okay, for my trading horizon. So that tells me clearly that I want to be a buyer of options.
Yes.
Then I still have a decision problems. Should I be a buyer of call options or put options? Right? That still remains to be solved. Okay, so now so that's why I've listed this, whether to type of option to buy or sell. Okay, in this case I've decided to be a buyer. Then whether I should buy a call or buy a put, how do we decide that? What is the process by which we decide that? Underlying what?
Asset.
Yeah, underlying asset what?
If it is bullish, then we buy or it's bullish, then we sell.
No, you're not in the selling box, because in this. So when we go to each decision problem, we assume that the previous one has been solved to help us to concretize the solution to the current one. Okay, so we make an assumption that we have solved the previous problem in a particular way. So in this case, I have locked you into this decision that on the previous question of buy or sell options, I took a bullish view on the eyeball. So I have now become a buyer of options, but I'm still not clear whether I want to buy a call option or a put option.
Buy call.
Right? In this case, what you're saying is correct, that basically, but you haven't worded it properly. So you take a view on the underlying asset. The correct answer to this question is, what is the process by which you solve this second problem, whether to be a buyer or seller of, in this case, a buyer of call options or put option, is you have to go and take a view on the underlying asset. Is this clear? Okay, so now you look at the Microsoft chart. Okay, so I'm just going to make it simple. I'm not going to pull up long-term charts and all that. Okay, so you take a view on the Microsoft chart and decide whether you want to be where do you think the underlying asset price is going. Okay, so this, let's say here also I take a view that the underlying asset price is going up. The underlying asset scale is on the left-hand side. Okay, so this is just under 140. So let's say my view is for the trading horizon, this is going to about 150, 155. Okay, so I have a bullish view on Microsoft. Okay, on the underlying asset, on the common stock. So in this case, what will I be buying? Because I'm going to be buying anyway. Should I buy a call or a put?
Call.
I should buy a call. So it's clear? So you solve the problems now. Okay, we're just recapping. We've done all this stuff. We're actually just repeating everything. But this is based on so therefore we say that this is based on the underlying asset view. Okay, is everyone following? Okay, how do we go through step by step, being aware of all the decision problems and how do we solve them? Okay, yeah.
Sir, I have a question, sir, that we should not look first that we should put call or put, but afterwards we should look that we should buy or sell or not.
Yeah, you can do that. I mean, what Garvit, if I understand you correctly, what you're saying is, in my decision problem 3 and 4, you would try to flip them around to make the 4 go first.
Yes.
Yeah, you can always do that. I've just chosen to do it this way because I was coming through the standard decision list of decision problems when we looked at underlying assets. Okay, so whether to buy or to sell. So I thought easily translatable into options, buying or selling options. So that's why I put it. So it's not a big deal. You can split. You can always put it. You can do the buy, call or put decision first, and then do the buying or selling of options decision second. That's not a big deal. Okay, you can flip it around if you want. Yeah.
Sir, not in the simulation, the project we have given, but in real life, if we have bought a call, so we can sell the call. That means that if we not sell the call, but we buy the put.
No, 1 minute. Now I'm confused. First, have you bought a call?
Yes, sir. I have bought a call.
Okay.
Sir, but
1 minute. Please be quiet. When he's asking, you've already bought a call. Yeah.
Yes, sir. But in this case, if we should sell the call. We should buy the.
No, I'm not. First, you have bought a call.
Yes, sir.
Okay, so that means let's say take this example of Microsoft. Your view on the eyeball is bullish,
yes, sir.
And the view on the underlying asset price is also bullish.
Yes, sir.
So you bought a Microsoft call. Now what happens?
So now the the share rises.
Okay.
So but I don't want to sell my call option.
Okay.
But I also want to protect it, so I can buy a put option.
You can do that. You can always buy a put option. Okay, so you can look at there. You'll have to get into considerations of you can always do that. You can buy a put option. Okay, you have one option is basically if you feel the upside potential is kind of exhausted, you can sell the call option, or if you feel there is still upside potential, you can buy a put option. But remember that in the case of options, we don't have so much of a concern with protecting risk, because what is the maximum risk in the case of an option? Right? So if I have bought, let's say, the 54.5 call for November, December in the case of crude oil, what is the underlying here? The underlying futures contract is the December oil contract, which is at 52.43. So if I have bought the 54.5 call at 153, what is my maximum risk? 153. Okay, so that's why. So what you're saying is not wrong. You can always buy a put. Okay, but generally remember that when you buy a put, you'll have to shell out some premium. Okay, so therefore, so there's one element of option trading strategies is whether it's a credit strategy or a debit strategy. So this is one, when you study option trading strategies, one of the aspects of every strategy you have to look at is whether this strategy is a credit strategy or a debit strategy. Credit strategy means what does it involve? Selling options or buying options? Anybody wants to guess? Selling, right? So what she is answering is correct, because if it's a credit strategy means you get money into your account, the money is credited into your account. So if money is credited into your account, that means you have been selling options, you're collecting premiums like an insurance company. Okay, so we can put this one, since we have discussed this point, we can put it in here in your notes as another point that we discussed, that option trading strategies. So option trading strategies, credit strategies will involve down below. Credit strategies implies option selling, okay, or it could basically means more options sold than bought. You could have bought some options, but you have sold more expensive options, so it's still a net credit strategy. Okay, so but get this idea basically that when you discuss option strategies, one of the things we look at is whether this is a net credit strategy or a net debit strategy. Okay. So we can write net also, just to net credit strategy and net debit strategy. This is another aspect that we look at in the case of option strategies. I probably will not have that much time to cover all these strategies and option strategies in great detail. So this obviously involves option buying. Okay. So actually, strictly speaking, what this should be is relatively, buying more, your total intake of option premium is greater than total outflow on option premium. Okay, and this is, so this I'm not going to write this, and here net debit means total outgo on option premium is more than total inflow on option premium. If you're doing strategies like what he's suggesting, buy one put, buy a call, then buy another put. In this case, yours becomes a totally debit strategy, because in both cases you're buying options. Okay, so these are more details of option trading strategies, which we will probably not have time, because after covering basics, I'll have to move on to other products like futures, forwards, swaps. Okay, so this stuff you do on your own.
Sir,
Yeah.
like he mentioned that first he got some call and then he's getting up with that market is still increasing. Then he's trying to purchase some put to safeguard his call. So in that scenario, how will he analyze the risk involved on the view on his view that the market can also go down?
See, in this case, when if you are buying a put, okay, that means he must have taken a view that the eyeball would continue to increase, but the underlying might fall. That is the only reason why you would buy a put, because buying a put has two parts. One is buying, and the second is put. Okay, so if you are buying options, means your view on eyeball must be bullish. Okay, so now you bought a put. That means your view on the underlying asset is bullish or bearish? Bearish. Okay, so therefore when he's buying a put, that means that his view is like his view combination is like this. That his view on eyeball is that it will continue to increase. Okay, and then the view on the underlying asset is that it is bearish. That's why he's buying a put. Okay, but as I said, normally people don't do this kind of thing, because on put options your downside is well protected. Okay, normally when people buy puts, they are usually trying to protect a long underlying asset position. Like, you did not trade options initially, you just bought the stock of Microsoft. You just bought the common stock of Microsoft. So this is typically what you would do if you are trading equities, and if you're trading into an earnings event. Okay, because in earnings events there's a huge risk. Remember we showed you that remember this chart which we discussed. If we look at, now we'll not see it here. If we look at this is an earnings event actually. This is an earnings drop on Facebook. Okay, so if you were long Facebook stock at this point, can you imagine how much money you've lost just through earnings? You can't, and you don't even have a chance to move. You don't have a chance to execute a stop, because this market closes at this point. Then after the market close, they come out with earnings, or before the market opens the next morning, they come out with earnings, and then the market opens the next day over here. So you don't have a chance to do anything. You can't even cut your losses. Okay, so typically what you should do as a prudent risk management strategy, so developing on the risk aspect that Garvit had focused on, and which you have also highlighted, that typically that strategy of buying puts would be employed more by people who are long, who did not buy options to start with, but they bought, let's say, the stock of Facebook. They were long the stock of Facebook, but they wanted to buy some, because you know that around earnings releases there is a tremendous amount of risk, because stock prices move around quite a lot, and this is not some mom and pop stock with low volume. It's a very actively traded stock. Okay, high market cap, actively traded, but even these stocks move. When it comes to earnings, you will see these massive moves in stocks. Okay, so even liquid stocks, you will have these massive moves. So one of the things you will do is, if you're long Facebook stock, you don't really want to sell your stock, because you still feel that Facebook has a lot of upside potential. You don't want to sell your stock, but you want to buy some insurance around the earnings date. So typically what you would do here is, you would buy a very short dated Facebook put option, because you just want to be able to get around the earnings risk. Okay, so then you would buy maybe close to at the money, or depending on how much protection you want to buy, because the more protection you buy, the more expensive it will be. Okay, and so that trade-off will always be there. So are you following now what I'm saying? Yes, you're following?
Yes, sir.
Okay, so the point that you raised is correct, is a valid point, that you want to always protect your risk as the market keeps moving. Okay, but typically when you have a long option position to start with, your risk is already protected, because your risk is already capped at that 153 that I paid for that crude oil option. Okay, the premium is the maximum amount you can lose. All right, so therefore you don't worry so much about protecting long option positions, the risk, but really where you have big risk is on unprotected long positions in the underlying assets, or short positions. It can go either way, right? So therefore, if at a point like this, going into earnings, you would typically buy a very short dated put option, to cover the risk of earnings. Okay, so if you bought an at the money put option and then the market goes and opens here, okay, so then you can exercise that put and cover your mitigate your losses. All right. So obviously you'll have to pay a premium also, and so that the net saving is you have to adjust it with the premium outgo. Is everyone following so far? Okay. So this applies to short positions also, because you can get massive moves. You remember once in Tesla, Elon Musk tweeted about a takeover, that Tesla was going to go private. You remember that? He had tweeted, funding secured, the famous tweet. Actually, he was disciplined by the SEC for that. I personally think they should have put him in jail, because that was clearly a market manipulation. He put in a tweet and there was no funding secured actually, so he lied. So he put out a tweet, and those guys who were short Tesla stock, they got burnt. It was somewhere around here, I think. So those poor fellows who were short Tesla, they got burnt because the market shot up after that tweet. It was, I think it was somewhere here. I think it was either here or here. This point when the market shot up, this happened. So this guy tweeted saying funding secured, and he's going to take Tesla private. You know what a going private transaction is? Going private means you buy out all the shares, all the publicly traded shares. You buy all the publicly traded shares. So if there's such a big demand shock, what will happen to the stock price? It's like a buyback. Okay, so you're buying back all the stock. Okay, so which means the price will tend to get pushed up. So all those poor fellows who are short Tesla stock, they all got burnt, and they actually sued him. There's a civil suit also on this. I don't know what happened to the civil suit, but the SEC didn't punish him enough. Okay, so the point is that you have this kind of, whenever you're long or short, especially in the case of equities, which have all these kinds of freaky movements. So you have this problem. So you would protect that the underlying asset positions, long or short, that you would protect around key events by using options, long option positions. Okay, is everyone clear? Okay. So we go back to our old set of decision problems which we are covering. Okay, so this is why I tell you guys to keep on following market. Like obviously many of you are not aware of all this stuff. So this is why I keep telling you to follow markets. You must be totally embedded in markets. All the time you should be following all the stuff that's going on in the market, and that's what a finance student should be doing. Okay, so you should know exactly what is going on, and this is how your experience builds up. Okay, and then when new things happen, you can connect it. You can connect it to things that happened before. Okay, and you can learn a lot. So you can get a securities law angle on this also, because there's market manipulation. Because all these things, when you go and operate in the real world, you're not operating in a vacuum. There's everything that is involved. Okay, so securities laws angles are involved. Okay, all these other kinds of regulatory aspects. Okay, so everything. So if this is why you should be following markets, and you should be aware of all the things that have happened in the markets. That's how your experience builds. Okay. Right, where are we? So we know these things which we have already chosen. Which expiry date to choose? This also we solve by, we can have, how do we choose which expiry date? This is, how do we decide this problem? How do we solve this problem? You remember we discussed this problem, that there is a problem of which expiry date? Yeah, yes, Parul. How do we, is my question clear? Yes. We still have a problem when I'm looking at these set of options. So let's look at so many different types of options in the case of crude oil. Okay, which strike should I choose? I can't actually, the moment I release it, I don't know, for some reason it seems to just, maybe I should go this way. Whatever, I'll just hold it there. Okay, just to let you see all these different options on crude oil. Which one should I choose? Okay, so what is the rule that we evolved, and what is it based on? Which important option sensitivity is it based on? I showed a graph. Yeah, so what is it based on? Theta. So the decision is basically based on theta. Okay, so which expiry to choose? It is here, I'm just going to write theta. So again, don't say expiry to base. What is expiry date? Then just say theta. So this is based on theta. Okay, and theta, we know this is not, you don't have to take a view over here. Okay, so essentially this is basically theta and theta versus, and actually we can put this as, what is the relationship that we make use of? Theta as a function of, now I don't want to make it so long, I'm going to remove this. English can be bad. Theta as function of yes, you remember this? The chart that Paul was referring to? What is the relationship that we take? So the first thing, the point is that when it comes to the decision on the expiration date, which expiry to choose, so many different expiration dates, how do we decide that? We basically focus on theta as one of the particular option sensitivity that we focus on. Remember all these option sensitivities? You guys have to do lots of reading, okay? So that all this stuff is embedded in your brain. Otherwise, if you just come to class and look at the look at the screen from time to time in between your WhatsApp, then this will not go into your head. Okay, so one of the important sensitivities is theta. So this is what we exploit to solve this problem of which expiry date to choose, and the particular relationship that we exploit is theta as a function of time to expiration. Right? So we know one thing that we know is does not require us to take a view. We know that longer dated options have lower theta and shorter dated options have very high theta. Okay? And so the other thing that you have to exploit is basically two things we have to exploit here. We exploit two things here. What is? Let's go back to that chart that Parul was referring to, this. Okay? So to solve the questions of the decision problem that we are solving is which expiration, whether I'm a buyer of options or a seller of options, that those decisions have already been taken. Now I have a further decision problem to take, which is which expiration should I be trading, having decided all this buy sell business. Okay, which expiration? For that we turn to theta, and we turn to this established relationship between theta and the time to expiration. So we know that longer dated options have very high lower theta, okay, and shorter dated options have very high theta. This is clear? Yes. That's one thing that we have to exploit, one relationship. This is a rule. There is no view taking required here. Okay. The second thing we also need to know, which is also a rule, which does not require any view taking, which is, what do we see? These are for the sensitivities are for long option positions. So what do we notice? The theta of long options is, yes?
Small.
No, not small. Negative. Okay. What do we notice? The theta of both puts and calls, because these sensitivities are given for long option positions. So when we turn to theta and we use theta and its relationship to the expiration date, we use these principles to solve what decision problem are we solving? Which expiration date to trade in, right? For that we use, please be aware of all this stuff. Don't just blindly do it. Be aware of all the processes in your brain. That this is the logical step. You should work your brain like a computer. Okay, a computer will always work logically like that. Okay, human beings, because we are so smart, we tend to just jump through. We don't even realize that we are actually solving a decision problem, but we have already solved it. Okay, but in this case, what you have to do is you have to be aware that this is the decision problem we are solving, and these are the rules that we are using or principles that we are using to solve the decision problem. Only then will you learn the theory properly. Okay, are you following what I'm saying? Yes, Aurora, are you following? Okay. So, first decision rule, that the first principle that we use is, again, does not require view taking, is that theta is higher for short dated options. Where is the chart? Yeah, short dated options have very high theta, and longer dated options have very low theta, or relatively low theta. Okay, and the second principle that we are going to use is that when you are looking at these sensitivities, or this is what I've told you, that when the model throws out these sensitivities along with the option premium, that these sensitivities are for long option positions. So what you know is that long option positions have negative theta, which means short option positions will have positive theta. That means they benefit from theta. Okay, so you take these two principles, okay, you keep them in your head, and then you decide to solve. Then you apply these principles to solve the problem of which expiration to trade in. Okay, so which means if I am a buyer of options, SG1, if I am a buyer of options, should I choose a longer dated option or a shorter dated option? 1 minute, let him answer. Is my question clear?
Yes, sir.
Not clear? You know which decision problem we are trying to solve? No. Now I'm asking you, which decision problem are we trying to solve? What are we discussing? Which decision problem are we trying to solve? Don't answer anything. Let him answer. Aurora, which decision problem are we now discussing? Whether to eat pizza for lunch or masala dosa? Which decision problem are we solving now? Expiry date. Which expiry date to choose? Okay. So coming back to the question of, now second question you want to answer? SG1. So if I'm a buyer of options, should I choose longer dated expiry or shorter dated expiry? Longer dated. Why? You have to answer in two steps, using the two principles that we have listed as the principles to be used to solve this decision problem. No, Aurora? You agree with this view? If I am a buyer of options, should I buy longer dated options or shorter dated options? Longer dated. Why?
Because theta is negative.
It is what? Theta is negative. Theta is negative for what? Short option positions. Long options. And your answer is not logically complete. You have to assume that I'm a computer. If you're talking to a computer, the computer is not going to be satisfied with the answer. You have to complete your logic. What is the logic? Your first part is okay, that theta is negative for long option positions and I'm buying options. So what is the next part?
Short and positive.
Not working. Okay. Gulati, can you finish the answer? Is my question clear? What is the second part of his answer which he was not able to give?
So that for a longer term option, theta is negative and for the shorter term it's positive.
That he has already answered. What is the second part? Anybody? Maybe my question is not clear.
Because theta said that the value of is decreasing at a lower rate.
Yeah, so you are hinting at the second part of the answer, which should be that, therefore, first of all, that long option position will have negative theta. So if my decision choice is between, given that I am a buyer of options, should I go for a longer dated expiry or shorter dated expiry? But when I look at this chart, I see that when I look at this chart here, if we do it here, then when I can see that, okay, both are, I can't escape the fact that if I'm long options, I will have negative theta. But at least if I go for a longer dated option, my theta is less negative than shorter dated option where the theta is very severely negative. It's like I'm choosing between two money losing investments. One is losing $10 and one is losing $600. So I will choose the one that is losing $10. Is this clear?
Yes, sir.
Are you following now, Aurora? What was the logic you should have mentioned? So understand, teach yourself to think logically. So this will improve your quality of thinking. So that the answer, you don't just give an answer, but you also logically give the answer as if you were a computer. Are you following, computer man? Gulati?
Yes, sir.
You're following computer logic.
Yes, sir.
That if I am long options, I will have negative theta. So wherever I go, I will have negative theta. So that is the first principle, that long options have negative theta, short options have positive theta. The second principle is that longer dated option, the theta is less negative than the theta for shorter dated options. Is this clear? Are you following the logic? Okay, what happens? Is anyone
Confused? Yes, sir. A lot.
No.
Start from the beginning.
Okay, 1 minute. Maybe by making you think through the logic, I'm making it more complicated.
Yes, sir.
Rather than just giving you a rule.
Yes,
Just by this. No. That's not acceptable. You have to understand the logic. You have to understand how the solution flows from the two principles. Okay. Now I have told you, yes.
So being negative for a longer term option, it means that the risk is less or there's some other risk.
No. What does see? Also you have to understand what negative theta means. What does negative theta mean? Negative theta means that, let's say this one. Let's say you bought both the options. Let's say you bought the call option and the put option. What does the negative theta number mean? That means every day the call option will lose 5 cents and the put option will lose 4 cents. Ceteris paribus, okay? If nothing else happens, every day that, because days will keep passing, at least time will keep passing, What does this mean? This means basically that when you are holding on to long option positions, if nothing else happens, every day the options are, that's why they're called a wasting asset. Options are called a wasting asset, long option positions, because every day the option will lose value. Yes, Pulkin, this is what you were saying, right? Yeah.
5.4% of exactly 5.
No, 5.4 cents. Yeah, I'm just saying 5. You're good, very good. Okay. So I'm just rounding it off, basically. Okay. It's just clear to you. Are you following?
This means the value is decreasing at a lower rate for a longer period of time.
Yeah. So the first thing from this, that you can't see from this chart. From this display, you can't see that. On this display, all you can see is that the principle that you extract from this display is that knowing that these sensitivities are computed for long options, okay, you have to teach yourself to think like this, otherwise you are not going to grow intellectually. As an MBA finance student, you should be able to give the answer, and you should also be able to say what are the principles that lead to this solution, not just give the answer, mug it up and give the answer. Okay, you have to know exactly what is the logic by which this answer is derived at. Okay, are you following?
Yes.
Okay, so from this chart you get this idea that long option positions, because these sensitivities are for long option positions, long option positions have negative theta. Yes, Tarun, you're following? Okay, so that is the principle you get from here. From this chart, what is the principle you get? This is also a principle, doesn't require any view taking. Okay, this is a fact. Longer dated options have less, long positions have negative theta, but compared to shorter dated options, let's put it this way, compared to shorter dated options, short and long is subjective of course, but I think 7 days is short and like 75 days is longer. Compare those two, then you know which is short, which is long. Okay, so the principle you get from this chart is that this is also a fact that longer dated options, the theta is less negative than the theta for absolute value of the theta. Now let's talk about absolute value of the theta is less for longer dated options than it is for shorter dated options. Is this clear? Are you following? What does this mean? It means that the rate of loss of value. Okay, let's go back to this. If you go here, the rate of loss of value here, Gulati, try to follow this. Okay, what does this chart mean visually? It means it shows you that this theta is much higher. Can you see that this chart is dropping? It's going down. Okay, it's a negative on the negative side. Okay, all right. So the negative side. So but here, so this is the zero line, and it's going down, and it's going down at a very sharp rate, which means the loss of value per day is very dramatic. But here the loss of value per day is not so dramatic. So it's like I'm forcing you at gunpoint to buy one of the two investments. You have to buy one of them, and one is losing value at $10 per day, and one is losing value at $600 per day. So you will obviously buy the one which is losing value at $10 per day. Is this clear? So this is what it means, that shorter dated, when you look at shorter dated options, their theta is the absolute value of the theta is very, very high. So the rate of loss of value is very high compared to a longer dated option. Is this clear?
Yes, sir.
The rate of loss of value is very high. So therefore, if you are going to be long options, because of the principle that long options always have negative theta, so you know that if you are going to be long options, the theta is always going to be working against you. Is this clear? The first point? See, you know from this line, from this display, from any option model display, that will also give you the Greeks. So you should know that these Greeks are calculated for long option positions. Okay, which means long options have long positive delta, long call options have positive delta, puts have negative delta, gamma. That's why you have to do all these readings, so you understand these concepts. Positive, gamma, vega, etc. Alright, but both calls and puts have negative theta. What does that mean? That means that if you have a long option position, if nothing else happens, every day that passes, that option is going to lose value. Yes, long option positions have negative theta. This is what it means. That's the first principle. Okay, but since you have decided to buy options, that means there's no escaping the negative theta. Okay, whatever option you buy, it will have negative theta because it's a long option positions. So now the question is, obviously, since you know that my investment is going to be losing value every day, I would rather that it lose less value per day than lose more value per day. That is common sense, right? So that is where you that is where this second chart comes in, which shows you the relationship. That's why I've said here in our decision problem that which expiry date to choose. To solve this decision problem, we use theta. We use the concept of theta, not vega or whatever. We use theta. And what exactly what aspect of this theta do we use? We look at the relationship between theta and the time to expiry. This is clear? We exploit that relationship to solve this decision problem. Are you following?
Yes.
Okay. So I've decided to be a buyer of options. That means I know the theta will always be against me, right? I have no choice. So then all I want to do is let it be less against me than being more against me. If I'm going to lose value every day, let me lose less value per day than lose more value per day. Obviously that's logical. And for that, what do? I look at the relationship between theta and expiration date, and I see that when there's a long time to expiration, the theta is less compared to when there's a short time to expiration.
Yes.
Is this clear?
Yes.
Okay. So that's why now if I'm a buyer of options, that's why we come to the answer that I would rather be buying longer dated options than shorter dated options. Is this clear?
Yes, sir.
So rather than memorizing, do you realize it's better for your brain? Your brain is getting little movement. Some movement is happening in your brain, right? So neural networks are connecting, right? So you're exercising your brain. It is better to know the logic by which the answer is arrived at than just know the answer. Is this clear? Gulati, is this clear now?
Yes, sir.
Yeah.
Sir, in the case of Morgan, put is always having a higher negative value as compared to, lower negative value as compared to call.
No. That's not necessarily true. You're talking about the theta.
Yeah.
Yeah. No, that's not necessarily true. Or at this point, we don't want to make these kind of assessments. We just want to look at basically that both have negative theta if you have a long option position. Okay, let's see one more. Yeah.
Sir, so if we'll be selling, so that means the theta will be in our favor.
Yeah, if you have decided to sell, if you are going to go short options, then the theta will always be in your favor. Okay. In that case, so we have not, your question is a little ahead of time. I want to first make sure that the logic is properly explained in the first case, which is where we are a buyer of options. We are a buyer of options, so we want to be a longer dated, we want to be buying longer dated options because we know that for longer dated options, the theta is less. The absolute value of the theta is less. So if every day if I'm going to lose some money, I would rather be losing less money than losing more money. So therefore I look at the relationship between theta and expiration date, and because I'm a buyer of options, I choose a longer dated option to buy rather than a shorter dated option. Is this clear? Okay. So is this clear? Everybody understand the logic? Okay. So now if you can see here, once again, alright, let's look at, so we have 30 days to expiration. Let's increase this. Let's make this something like 90 days. So look at the theta for the call option, just remember that. So 0.054. Okay. So if I'm now going to increase the expiration, what should happen to the theta? Theta should become more. I'm going to make the days until expiration from 30 to 90. Theta will become more negative.
Less negative.
Let's check. It becomes less negative. The same thing is here. You can see it here. You can remember the visual charts are easier to remember, but you should remember this both intellectually and visually. That if you plot theta against time to expiration, it's always going to be below the zero line because you're plotting this for basically the long. This theta is showing you for a long option position. So if you're short, then it'll just be flipped around. This is a profit for you. Okay. So the same thing that you see here, that for longer dated options, the theta is less, and for shorter dated options, the theta is higher. Are you clear, Parul? Are you clear about this? Okay. You're sure? Okay. So now when we went from 30 to 90 days, the theta became less. From second decimal 5 cents, it went to second decimal 3 cents. Because we have now chosen a longer dated option. Right? Is this clear? Gulati, are you following? So if I'm a buyer of options, I would rather buy a 90-day option than a 30-day option. Right? Is this clear? Okay. Yes, Aurora, are you following? Yeah? You got all the steps? SG1? Yes. You got all the steps? Okay. Alright. So, this is what we use to solve. We go back to our decision problems. So this is basic. So remember that we are using these two principles. Okay, so maybe we should use this. We should write this down so that you have a. Or maybe we should not write this down and make you watch the video. Yeah. So theta is the function of expiry. No, I'll write it as a option. This is option position versus sine of theta. This is the first principle. Let's write it in abstract terms so that you don't gain anything by blindly memorizing it. Okay? Posi means option position, short position. This is a short form for position. Okay? Option position versus sine of theta. Is it clear what I mean by this? What this means is that long option positions have negative theta and short option positions have positive theta. Okay, that means the theta is working in your favor when you're short options. Yes? That is the first principle. We can call it 1. Second principle is, what is the second principle we discussed? That theta versus absolute value of theta versus time to. Is this clear? Logical? How to logically arrive at answers? Have you understood now, Khushbu? Tarun, is it clearer now? Okay, everybody was getting confused because we were going through the logic, but this is what you have to get used to. So everything you learn, okay, every concept that you learn, you should be able to explain it to yourself through such logical rules rather than just mechanically mugging it up. Okay, you have to be able to explain it as if you are explaining to a computer that this solution comes out logically through these rules, through the application of these rules. Okay, so these rules are, this is basically, these are being taken as axioms. Axioms, you remember from mathematics? Axiom is something which you take as given, as true, and then you use that axiom to make, to come out with a proof. Okay?
Like a
Yeah, you assume, not really a hypothesis. Hypotheses are different because hypothesis may end up being false or true. The axiom is assumed to be always true.
So the reasons to prove the theorem of hypothesis is true.
Yeah, no, axiomatic proof means you assume certain axioms are true. That a right angle triangle has whatever, so you know, by some 90-degree side or whatever. And then based on those truths, you prove something else. Okay, so these are like axioms that you use. Okay, that theta will always be very high, absolute value of theta will be very high for shorter dated options as opposed to longer dated options. Okay, you use that to solve your decision problem. Okay, so this part is clear now. We go back to the decision problems. Which strike to choose? This we have already discussed earlier. I'm not going to repeat it. Okay, it's already been discussed earlier, I think, by reference to views on the underlying asset price. That's one way. But the more correct, the more theoretically correct way is to take a view on the eyeballs. Okay, and therefore, if you are a seller of options, because here you can't see the option eyeballs because you can see a little bit. Okay, maybe yeah, you can see it this way. Let's not expand it. You can see it here. You can see the closing eyeballs here. Can you see the differences? So really, what if I'm a buyer of options? Can you see the display here? Can you see the display here? Now, if I'm a buyer of options, which one, by the eyeball rule, which one should I choose? Yes, Sukriti? Is my question clear? If I'm a buyer of options, now I have a problem of which strike to choose. Okay, in this case we don't have, let's assume these are actually strikes because I've already chosen the expiration date. Yes, okay, so I've already chosen the expiration date. Okay, I just want to just pause it here because I just remembered some of the expressions. Now those who have done, if you do badly in this exam or some other exam, Don't take it as some kind of major catastrophe in life that you have to go on sannyas or something like that. Just these are all things like because I'm looking at some of the expressions and I get really worried. So these are exams. Okay, maybe you didn't prepare properly, you gave it sloppily, you didn't answer all the questions, you didn't attempt all the questions. So, but then life is much bigger than one exam or one degree or whatever like that. Okay, so don't look at learning. Don't focus so much on exams. Look at learning. What are you learning? Because learning will give you confidence. Okay, not exam scores don't give you confidence if you haven't learned the subject. So you master the subject, focus on mastering the subject. Life is a very long game. It's not a 100-meter sprint, it's a marathon. Okay, so some setback, your LLB scores are low, you have a second division in LLB. Don't worry about all these things. These things don't matter in life. Okay, life is much bigger than all these small things. Okay, so I just thought I'll give you this because these days kids get very hassled when they have bad exam results. These are not exams, are basically a waste of time. Yes. Okay, these things are all okay, 1 minute. So I actually got into a lot of trouble in Ahmedabad because I wrote a proof in one of my papers that exams and quizzes are a waste of time. So I wrote a mathematical proof. So eventually I was forced to give that exam because again the teacher told me that if you don't give the exam again, I'll give you an I. Then obviously I can't go out without a degree, so I had to give the exam. But he could never prove that my proof was wrong. That we'll do later. Okay, coming back, let's assume, because I don't have the eyeball displays. 1 sec. Let's focus on the decision problem. Okay, we need to decide which strike to choose. Okay, which strike to choose. Okay, and I've given you two options. Two ways to do it. One is the slightly cruder method, which is to take a view on the underlying asset and see that this is going to not go above. Let's say, for instance, the way you do that there is if you're selling a call. Let's say this is $55. This is around $140 on Microsoft, and you feel Microsoft will not exceed $140, so you sell a 140 call. The idea is that if Microsoft is never going to go above $140. Then the person who buys the 140 call will not want to exercise the call. Are you following the logic? We've done it once before. Okay, so then basically you just pocket the premium, because when you sell options you earn premium, right? Like an insurance company which sells fire insurance, but there isn't a single fire in the country, so they collect all the fire insurance premiums and they don't have any claims, right? So that's what you want. You don't want the option to be exercised. So you take a view on the underlying asset, 140, it won't exceed 140, and then you sell a 140 call. That's one way. That's a slightly cruder way of doing it. The better way of doing it, the more scientific approach to doing it, which is what you should learn, is that let's assume these are not expiration date, that these are actually strike rates. So I'm just asking you to imagine that these are different strike rates. You have already chosen the expiration date. Okay. Now what is the way? Now you can see the eyeballs over here. So now Sukriti will tell us, assuming these are all expiration dates, this is the at the money, and these are out of the money calls, and these are out of the money puts, these are in the money calls here. So if these are the strikes, now which, using the eyeball rule, 1 sec, be clear, what is the decision problem we are solving? Which strike to buy? Having decided the expiration date and all other problems, we still have one problem left. Which strike to buy? Now we are talking about two ways to solve it. The second method we are using, which is the better method, more scientific, that is by using the eyeball. Using eyeball as an index of option prices. So if I am a buyer of options, which eyeball in this display, you can see everything. Am I blocking it? You can see this last column. Can you see it? You can't see the last column. So I will move out. Now can you see? Can you see? Yes or no? What? Can you see it or no?
No.
You still can't see this? Okay. 1 minute. Now can you see it?
Yes, sir.
Okay. Now tell me which eyeball will you choose if you are a buyer of options? You can see all the last column. Which one will you choose? Yes, Sukriti? Is my question clear? Question, 1 minute. Don't answer for her. She will answer. 1 sec. 1 sec. Be quiet. Which one will you choose? Which is the third one? 36.1. Okay. Alright, okay. So my question was clear that if you are a buyer of options and you imagine that these are not expiration dates because we don't have a live market right now. Okay, these are not expiration dates. These are actually, if I go to a live market, I won't see the eyeballs. So I'm assuming that these are not actually expiration dates, but these are strike prices. These are different strike prices, and these are the eyeballs associated with those option prices for those strikes. Okay, because you still have to choose the strike, right? And you are saying you'll choose the 36.1. Okay, anybody else with a different view?
No, sir.
1 minute. Gulati, yes.
What about that April 20, May 20? If we are not having any I will then.
This is not to be considered because we don't have a value. So no, because there must be some system problem. There must be some system problem. I don't know why there's no eyeball here. There may have been some system problem, calculation method. Okay, but that you disregard that row. Disregard that row. Okay. Yes, Aurora, is my question clear? Which one should I choose if I'm a buyer of options? Is everyone clear about my question?
Yes, sir.
Yes, sir.
We still have to solve. We've decided the expiration date and we are pretending that these are actually strike rates. These are strike rates and these are the eyeballs associated with those strike rates. The mid price of the eyeball, not the bid and offer. We don't see the bid and offer. So now, is my question clear, Aurora? Which eyeball should I choose if I'm a buyer of options? Which one? Third one. You're also agreeing with Sukriti. 36.1. Okay. Anybody else with a different view? Everyone, nobody disagrees? Ritesh? My question is clear. Which eyeball should I be buying? Which strike rate associated with which eyeball should I be buying? Okay, so which means you actually identify the eyeball first and then you go left and choose the strike. That particular strike. Nobody disagrees? No one? 36.1, what is so special about 36.1? So when I go and try to buy something, I should buy the one which is more expensive.
No, sir.
Which has more chances of getting up the top.
No. What are we doing here now? We are choosing strikes. We have decided everything else. We've decided to be a buyer of options. We've decided to be a buyer of call options based on the underlying asset view. We have chosen the expiration date. We have chosen a long expiration date because we are a buyer of options. We have chosen 90-day options, let's say, as opposed to 13-day or 7-day options. Are you following the steps? Yes? We've gone through all these problems. We have chosen to be a buyer of options, then we chose to be a buyer of call options, then we chose a expiration date, long dated expiry like 90 days because we don't want to have a short dated expiry with high negative theta working against us. Now we still have one more decision problem, which is which strike price, having chosen the 90-day options. Let's assume that these are all 90 days, this is within the 90-day option, these are all the strikes. Are you following my points? Are you following the statement of the problem? Yes? So let's assume these are 90-day expiry. We chose 90-day expiry and these are all the strikes within the 90-day expiry. Okay, imagine that these are strikes. These are obviously not strikes. Imagine these are all like 55, 56, 57, 58. So now I still have a problem having chosen to buy 90-day calls. Which strike price should I choose? And I've told you that the second rule of solving that problem is a more important, more scientific rule, which is we solve it by eyeballs. Okay? Yes, Gulati now?
Sir, according to me, 26.5%.
Yeah, correct. So that is the right answer in this display. Because if I am a buyer of what is the logic? If we know, here again you have to use two principles. Always try to think as if you are explaining it to a computer. Always try to adopt this logic because it will help you, it will clear your thinking. Okay? What are the two rules here? That eyeballs are an index of option prices. First rule. Eyeballs are an index of option prices, which means higher eyeball means this option is more expensive. Lower eyeball means this option is less expensive. This is the rule, first rule. Yes? Second rule is, again, very obvious. That's why I said human beings just solve decision problems without realizing the rules are being applied. The second rule is because a computer doesn't know. So for a computer, you have to tell the computer that if you are buying, you should buy the lowest price. If you are selling, you should sell the high. How will a computer know if you don't tell him? Computers don't know anything. So for a computer, you have to even tell him, when you are buying, buy the lowest price. When you are selling, sell the highest price. Are you following? So you have to learn to teach yourself to think like a computer, as if you are explaining the instructions to a computer. This will help your logical, it will make you think more logically. Okay? So the two rules that are being used to solve this decision problem, again, two principles. Okay? First is that eyeball is an index of option prices. So higher eyeball means that option is more expensive. Lower eyeball means that option is less expensive. Okay? First principle. Second principle is, when I am a buyer, I want to buy the cheapest at the cheapest price. When I am a seller, I want to be selling at the highest price. This seems very obvious, but we have to state it as a principle. Yes? Now using these two principles, can you see that Gulati's answer is correct? Yes. So we should identify the lowest eyeball, okay, and then we should go left or right to see what is the strike price associated with that lowest eyeball. Yes? We have imagined that these are actually strike prices. We are imagining these are strike prices. Okay? So then, if this is 56, then we first see that the lowest eyeball is here. Then we go left along that row and we choose 56. Is everyone clear so far? Yes. Yes? Kanika, you're convinced? Okay? We have asked you to imagine that these are not expiry date because we don't have a live. If we were teaching this class at 8 p.m. In Delhi, then we would have US markets open. I could actually show you live ball prices and all that. Okay, but that you will see on your own, right? Okay, yes.
Does that mean that if we on the ball side, we will select the higher theta because we want to sell. So the higher eyeball will be selected.
No. Your question is sounding very confusing. What do you mean you're on the call side? No, you're not on the put side or the call side. Either you're a buyer of options or you're a seller of options, and then you're either a buyer or seller of call options or put options. Now tell me, what are you? Are you a buyer of call options or you're a seller of put options, or what are you? First set the context, then we can answer your question. Are you saying, I am on the call side, I am on the put side? That doesn't make any sense. You have to talk in terms of positions and option types. You know there are two types of options, calls and puts. And how many types of positions? Long and short. So whenever you're talking about some situation like Garvit was saying, he had bought some call options, then he wanted to buy a put option. That makes sense because I can understand what is his position and what type of options. So what situation are you talking about? Have you gone long call options or have you gone long put options? Yes. What happened?
So in that context, I don't know, but
No.
I'm just...
Okay, now tell me, now let's try and understand your question once again. Okay, guys, please be quiet. Let's try and understand what her problem is.
I'm just finding a logic that if you're on the put side, then we will take the lower...
No. There's nothing to do with put side. The put side is only being shown because Sukriti could not see, so I brought it like this. Because in this display, they are showing the eyeballs, the average eyeballs. Okay, forget about put side and call side. The average, this is the average of all. These are the closing. See, remember, this is now, we have not expanded the expiries. Okay, and we are not able to see, for some reason they are not showing but this actually should be trading. I don't know why they are not showing maybe it will take a little time to load. Okay, for some reason they are not showing the eyeballs when you mouse over. Okay, so maybe these options markets don't trade on Globex, so we'll have to see why this is happening, or maybe it's just taking a little time. So you forget about that as on the put side. You take this as the average eyeball. This is the average eyeball for this expiry. Are you following? This is not put side or anything. So did you follow the rules? You understood the problem? What is the problem we were trying to solve? The problem we were trying to solve is here, which strike to choose. And here we assume that all the previous problems have been solved. And we assume some type of solution. That between long and short we have chosen long. Between call and put we have chosen call. Okay? To solve one decision problem, we make some assumptions about how we have solved the previous problems. Okay? This is clear? Are you following? So right now I have a problem. I chose to buy call. I chose to be a buyer of options. I chose to be a buyer of call options. I chose a 90-day expiry. because I'm going to be long option, so I don't want to choose a short dated option, because if I have a short dated option, I will be hit by massively negative theta if I buy a 7-day or a 14-day option. Okay, I don't want to be hit by this kind of theta. I would rather go long and take 90 days, 180 days, those kind of options where the theta is much less. So every day the hit I'm taking from the theta is much less. Okay, so I solved all those problems, but I still have to decide which strike to choose. If you choose any expiry, you still have a problem of this. Which strike should I choose? 54, 53, 53 out, 54, 54 out, which one should I choose? Okay, so here we are not getting, for some reason, we are not getting the eyeball mouse over. When we mouse over, we are not getting the eyeball figures. Ideally, you would get that for US equity options in US time. Okay, then you will see this, but in the absence of that, we wanted to just show you the eyeball figures, and we wanted to pretend that these are actually the strike prices for 90 days. For 90-day expiry, having frozen it at 90-day expiry, we wanted to pretend that these are actually strike prices, and these are the average eyeballs for the different strike prices. Is this clear?
Yes.
Is your question getting, are you getting more clarity now?
Yes.
Okay, so that's where Gulati gave us the right answer, that we should be buying the strike price associated with this eyeball, because he scanned all the eyeballs and he found that this is the lowest eyeball. So he has used two principles, that lower eyeball means cheaper option, higher eyeball means more expensive option. The second principle he has used is that when I am a buyer, I want to buy the cheapest price, and when I am a seller, I want to sell at the highest price, right? Using these two principles, he has come up with a solution that I should choose the strike associated with this lowest eyeball since I am a buyer for this expiration, and then we go here, we go along to the row, and we see what is the strike associated with this eyeball. Is this clear? Yes, Tarun, you are convinced? Okay, so everyone is clear now how we have solved it. We are actually just repeating the stuff that we taught in the previous class. So it's not like we are having, these videos are not like instructional videos where you have one topic and you move on to the next. Because when these are live classes, so when I look at people's faces and I see they are looking lost, so obviously I can't move on to the next topic. So I have to teach it again, right? So that's why we are covering pretty much the same topic in subsequent classes also. But please make sure you do your readings, do your book readings. You have to master all these concepts. If you go for an interview or an option for whatever, somewhere you go to an interview, SFC or whatever, for trading interview or something like that, for a trading position or even a sales position, you should understand financial products. You have a finance MBA. You should understand financial products inside out, which means options, Greeks, all kinds of option strategies, eyeballs, movements, historical volatility. Everything should be like that. It should just be coming out like that. And instead, everybody looking lost. So it should be much more, and that only comes when you do enough practice on your own. Okay. So now we still have one more decision to make. Okay, where are we? We have 1 minute. We have 1 second. 1 minute. Yeah. No, that is a separate problem. We are still actually just coming at this family of problems. This entry price, we have already done this. This is going to be done the same way. You are already familiar from your NSE project when you are trading only in underlying assets, okay, spot equities. This we have already solved, entry price equal to greater than whatever market price, what kind of orders you use, that we have already decided. You take a view on the underlying asset and the eyeball and you decide whether the option is going to fall in value or rise in value. If I'm going to be buying options, okay, once again let me just take say 36 days. Okay, I'm looking at all these options. Let's say I'm looking to buy puts. I will basically take a call on this. Right now the puts are around 350. So I take a view on the underlying and the eyeball and I decide whether the puts are likely to fall in value or rise in value. If I think they'll fall in value, then I'll place a limit order for this put. Now the same logic you are applying to the underlying asset, now you have to apply to the option. But you should be able to apply that same logic. You just take that logic and apply it here. Okay, you should be clear about that. Okay, so that problem is solved. The second, the problem that we have not exercised decided is this one which Tanya brought up. Okay, indirectly. That early exercise, basically what we are going to do is, after you buy the option initially, after you buy this, that's why I said after initial transaction. After initial transaction, you have these other problems. Should I do early exercise Or should I, that's why you see 9.1 and 9.2. The basic choice is between 9.1 and 9.2. And then in 9.2 you have two other decision problems, okay? Plan to exit at loss. If you buy the option and the option keeps on losing value, you can always sell it off in the market. You don't have to hold it to expiry, okay? You can always sell it off in the option, in the market. So you can trade the option just like an underlying asset. You take views on whether the option price will go up or down. And then if you feel the option is losing money, then you can sell off the option. And even when the option is making money, you can sell off the option. So what we are doing is basically, for the purposes of this project, we assume that no early exercise, okay? There's actually some material on early exercise. It has connections to dividend paying and all that. We are not going to complicate, I'm just going to write it as for now. No, that for now means that it's meant to tell you that this is not an absolute rule. This no early exercise is not an absolute rule, but for now I'm just giving you this rule that you should be aware that you have this decision problem, as she correctly pointed out. That after buying the option, you have two choices. You can exercise the option early, or you can sell the option in the market. So I am forcibly for solving this problem for you by telling you that in this project right now you don't worry about early exercise. You apply a rule that there is no early exercise. Although you are trading American options, you can do early exercise. This is clear? But that's why I'm writing this caveat for now, which means basically this is meant to tell you, don't go and tell your interviewer that teacher said that you never exercise options early. That's not true. There can be situations you might do early exercise, but we are not handling those complications right now. So we are working with a thumb rule right now, crude thumb rule, that no early exercise, to make our life simple. Okay, is this clear? Yes. What is the other type of option for which you can do early exercise other than American? Bermudan, correct? So European style you can't do early exercise, okay? Only Bermudan and American, okay? So fine. So we have just recapped everything. Again, I've taken 2 minutes extra. So Garvit is very angry, but we can close now. Any technical question? Yeah, Gulati has a technical question. Yes,
sir, not a technical question.
No, then if it's not a technical question, just wait. Yours is technical.
Sir, actually,
so then I won't close the video.
Sir, I wanted to know, like, then you're showing the theta prices in the calculation portion.
Yeah. Yeah. One second. Yeah.
So here, like the theta is 0.03, minus 0.03 for call option and minus 0.02 for put option.
Yeah.
So the theta for call option will always be on the lower side, the lesser than the put option.
No, it's not less. Actually, the magnitude is more.
But sir, in a simple mathematical way,
Yeah, it seems. I mean, I have not actually addressed this problem. I can look at it, but essentially it seems to be that way. That for all situations, the theta of the put is always more than. I'm not. It's good that you have actually focused on this problem. And for every type of, there must be a theoretical reason. So I'll just think about that. Yeah, the put theta seems to be always less than the call theta. So it's interesting that I never looked at.
The call option, the call theta is lesser than the put theta.
No, where is it less?
Sir,
Less means we are talking about absolute value.
okay.
It's always more.
It's 3 cents and it's 1.7.
Yeah. What you're saying is correct on a magnitude, on the scale basis, on the number line. But you're right. It's good that you pointed out this relationship. It seems to be always more negative, and absolute value is higher. Yeah, it is always more negative. But there should be a logical explanation for this. I'll have to think through. I've never really thought about this aspect of the problem. So it's good that you pointed it out. It's very good. It means you're now attending classes more. You're more attentive rather than thinking of MMA. Your MMA, I'm very concerned about MMA. It might be a distraction.
So actually, it's done for self-control and.
Okay, good, fine. If it's that, many traders have a samurai. You heard of the samurai? You can read books on the samurai. Their thinking and approach to life is used by many traders. Okay. So, any other technical question? Yes, technical question. Yeah.
Sir, suppose I have bought an option.
Okay.
And its expiry date is after 60 days.
Okay.
And if I do not sell, and if I do not do any action with that option now,
Okay.
so does it get automatically exercised or it vanishes?
Okay, so at the expiration date. Yeah, so on the expiration there is a rule that most exchanges will have a rule. So when you're trading options typically you'll be trading options on exchanges. You can also have options as OTC products. As a general rule, you should understand that. Okay, we haven't had time to discuss OTC versus exchange traded markets. But in this case, you are trading options on exchanges. These options that you are trading, American style equity options, US equity, these are exchange traded options. So exchanges will have a rule that options can use some X%. So you have to find out what that rule is. So those options which are in the money. So if you have an in the money option at expiry, okay, so if it is all in the money options with some kind of cutoff, they might have a small cutoff, they will automatically exercise the options. So if you forget, okay, they will automatically exercise the option. So this you have to find out from the exchange, and the brokers will also have some rules. So mainly you have to look at your broker rules and the exchange rules. So you should be aware of both the rules. So this is driven by automatic exercise of in the money options is driven by broker rules and exchange rules. So whatever you are trading, you need to investigate these rules.
While doing this project, we will have to take care. If we are trading a 14 days option, then we have to see whether it gets exercised automatically or not.
Yeah, so in this case you have to check the IB rules on automatic exercise, and you have to check the particular exchanges. But IB rules will suffice because IB rules will override the exchange rules. You can just explore early exercise, automatic exercise. Alright? Yes. Non-technical. Non-technical.
Like you all mentioned that to buy or sell, we need to check the IOR.
Yes.
And so, but after looking at the situation of the theta, then it also means that we have to look across the theta value as well. That if we are going to purchase the correct amount, the correct option or not. This means theta is also a necessity for buying.
No, you don't normally. I think what you're getting at is this part, right? That the theta of puts is less than the theta of calls. Yeah. So this you don't worry about so much. Okay. This is it's good that you pointed out this feature, but this is not really an operative factor in our decision making. We are more concerned with we take a view on the eyeball. We take a view on the eyeball to decide whether we want to be buying options or selling options. Then we take a view on the underlying asset to decide whether we want to be selling or buying calls or puts. So we decide those. Then we decide the expiration date by looking at, if I'm a buyer, I want to go longer dated, so that my theta is less on a daily basis. And then if I'm a seller, I want to be selling very short dated 7-day options kind of things.
Not a necessity for on operational basis whether to buy or
No,
sell.
I wouldn't say theta is not a necessity. Theta is a necessity because you have to be aware of this relationship. You have to be aware of this relationship. This you have to be aware of. But the fact that theta of puts is less than the theta of calls, that is not a factor because we are not in the hierarchy. That automatically gets eliminated as a factor in your decision making. Because whether to buy a put or a call or sell a you are deciding by some other rule, the view on the decision of, on the underlying asset. So therefore this automatically gets eliminated. But it's very good that you are focusing on it. Right? Okay, good. Yes. Non-technical question.
Not non-technical.
Okay, 1 minute. So non-technical question means I'll close this.